The continued calls from macro desks, Goldman's a good example today, reaffirming their view that a mid-year low is S&P 2K, but you end the year at 3,200. I mean, how valuable are these pieces of forecast right now?
So, when we think about putting a level on the end of the year, I think it's a guessing game, and it's anybody's best guess at this juncture. One of the things that we've been most focused on in trying to figure out where the low may be and where the ever-elusive fair value may lie is thinking about, what's the right multiple to put on equities, and then importantly, what's the right earnings number? And I think that's something very different from, say, December 2018, when earnings estimates didn't really move around all that much. You're finally beginning to see earnings come under pressure here, and there are questions around how low earnings estimates for this year will go. I think the key thing for investors is to look through, right, is to understand that eventually at some point the market will start to look through what's happening with the virus and price in a virus-free run rate, and to me that's what we really need to see in order for markets to find some stability.
And that'll be based on a second derivative of caseload? Any doubt about that?
So, I think that it's very closely tied to the growth rate that we see, and the exponential growth that we're seeing obviously suggests to me that markets probably have some downside from current levels. But, at some point, and I would agree, the middle of the year, if you think about the pace at which this virus has grown, if everybody in the world could get it, they would have it by the month of July. So kind of that worst-case scenario plays out by the middle of the year. Hopefully, at that point, you begin to see things, more normal activity start to get priced in.
All right, Mark, let's talk to you about interim solutions. That's going to be the topic of discussion for weeks to come, and with time obviously of the essence. What are you making of some of the reports about worst-case forecasts for unemployment starting in Q2?
Are you referring to the 20% unemployment rate that the
I think the reporting around that has been messy, but yes.
I think that's an overstatement. I mean, the unemployment rate peaked at 10% on the nose in the financial crisis. But, I don't know that it makes much difference if it's 20% or 10%. It's really, really bad. So if that's what it takes, if it's that kind of conversation that it takes to get Congress to move and the administration to move towards a package of stimulus, both in terms of getting cash into the hands of households and small business in particular, and also helping to make sure that credit continues to flow in the fixed income markets, that's fine. I do think they need to be on high alert and get moving here. And if it takes that kind of number to get them moving, I'm all for it.
Mark, the general sense out there has been that whatever fiscal measures we get obviously are going to be intended as a bridge to when we can get back to something closer to a normal economy. And the thinking is, look, the economy was in pretty good shape without significant imbalances or acute vulnerabilities going into this crisis. Does that change the longer this goes on? In other words, can we have wear and tear on the fundamentals of the economy? What would you be looking for in that regard?
Yeah, I never agreed with that narrative, Mike. The economy wasn't strong coming into this. It was on its back heels. That trade war did a lot of damage. Manufacturing, transportation, distribution, agriculture were all in recession. We were barely growing enough to maintain the low unemployment rate. So, I don't think we were that strong coming in. The Fed cut interest rates 3 times last year. That's not consistent with a well-functioning, healthy economy. So, and then to your other point, as long as the economy and the financial markets remain under this kind of stress, the odds of something else happening, something else breaking in the credit markets, for example, rises. So it's very important, critical that Congress and the administration at this point come together, big stimulus package. Also they have to come up with something with regard to making sure that there's still credit flowing into the economy. So I think that's going to require some support from Treasury in combination with the Federal Reserve. They've got to do those things pretty quickly so these stresses don't completely undermine things and something else breaks.
Yeah, well, Mark, we've been talking about that in the last hour, the need to get the money to businesses who will then guarantee employment for their workers, in businesses in particular that are being hard hit, though many are, and conceivably would be laying those people off. It's a fairly complex problem. Is it your sense that we will be able to get there, given the input you need from Treasury, from our political leaders, from Congress, and everybody else?
Yeah, I think so. I think what we need is a much larger credit facility seeded by the Treasury. The Treasury puts up the equity, gets the Fed to participate, and it backstops the banking system in particular so that the banks have a way to continue to lend to their business borrowers. They can continue to extend those lines of credit and other loans and hopefully reach down and help some of these smaller businesses that are going to have obviously have a great deal of difficulty here. So it's going to take more than this, the Fed here. It's, I think, going to take the Treasury, and we need a much larger, more creative credit facility. And I suspect I know they're working on that, and I think that's something that will come to fruition.